was a tough start to the month of September for the Australian share market, mainly caused by wobbles in the US, especially with tech-related stocks, and also the trade wars being very much in focus. Having a look at what's been impacting domestically, and let's start off by having a look at UBS and the banks. And we know that now 3 out of the big 4 banks have raised their variable interest rates. We have seen the repricing not only because of rising wholesale funding costs, but also for support to profits as well. So we've seen Westpac now raising its variable interest rate by 14 basis points, Commonwealth Bank by 15 basis points, and ANZ by 16 basis points. It means that more than the cost of funding is being passed on, and especially with ANZ, where its additional wholesale funding costs are probably around about $150 million, but the repricing effort comes to around about $300 million. So the repricing is not only about supporting the net interest margins, but also supporting profitability. Having a look at Macquarie and the contractors, its preferred one is Downer EDI. Downer EDI has guided to 13% growth, and cleaner numbers should be ahead. Macquarie is saying that risk management in a more buoyant sector has come back into focus, and Downer EDI and Monadelphous have the best long-term track records in this regard. Having a look at Citi and property, their top picks are Goodman Group, Charter Hall, as well as Lendlease. Each one benefits from leverage to ongoing strength in property values and or significant development pipelines, which supplements assets under management. Their least preferred names are BWP Trust, Essentia, as well as shopping centres Australasia, with retail landlords facing ongoing operational headwinds. During reporting season, we also saw a downgrade to Mirvac as well as GPT from a buy down to a neutral. Ords having a look at equity strategy post-reporting season. And look, PE ratio expansion has been the catch cry of the day. On their reckoning, the multiple of the top PE quartile of the S&P ASX 300 index climbed 4.2 points in the month of August. And it says that such a move is extraordinary in itself, but more so considering earnings for this group fell on average. They say that unless earnings trends improve, the risk of a group-wide multiple de-rating is high. And in terms of the outlook, their team sees downside risk to consensus earnings expectations. So a bit of a dampener on market performance there. Morgans and its high conviction portfolio to its X100 list, it's added Noni B and the Australian Financial Group. And to the top 100 list, it's removed Suncorp. Their high conviction stocks are those that they think are the highest risk adjusted returns over a 12-month time frame. And finally, ending off with Bell Potter and some of the more interesting stock calls, they have a sell on GrainCorp, saying all eyes on the sky, the likelihood of well below average 2018 and 2019 harvest suggests that it's unlikely that GrainCorp will see a normalized earnings base until FY21. They also have a speculative buy on Frontier Digital Ventures. This is an investment company that owns a variety of stakes in online classified companies located in fast-growing frontier and emerging markets. So all in all, a bit of volatility returning to the market, mainly being caused by one eye on the trade wars and the other on what's happening in terms of emerging markets and tech stocks being heavily hit in the US. I'm Julia Lee, an equity strategist from Bell Direct. Hope to see you next week.